How top traders handle losses and why it matters. Let's start with something a lot of traders miss. It is not a success story, it's a way of thinking that makes tough market moments easier to manage. After a margin call and a string of heavy losses, Tom Haggard learned something that reshaped how many traders think. The best traders aren't the best predictors, they are the ones who know how to handle losses the right way. So here's what happened. More than 20 years ago, Tom shorted the Dow at the very top with full confidence. If he had held the position for a few months, he would have made a huge profit, but he didn't. He got margin called instead, and fast. Brokers didn't protect accounts the way they do nowadays, so the losses stacked up. Trying to make it back emotionally only made the situation worse. But then something shifted in his mind. You see, Tom stepped away from the market and walked the Camino de Santiago. Along the way, he met a former Special Forces soldier who said something simple but powerful. Training helps, but the real test is staying sharp when things get stressful. That one idea changed how Tom approached trading forever. When he came back, he traded very differently. The goal wasn't trading anymore itself. He came back to understand his own behavior. He broke down every losing trade, why he entered, what he felt, where the exit should have been, and where ego stopped him from taking the stop. He reached a clear conclusion. Keep losses small, let winners grow, and make decisions the way someone would in a high-pressure environment. His win rate actually dropped, but his results improved, because his risk to reward finally worked in his favor. And here is the part that most traders tend to overlook. The best traders aren't the best forecasters, they are the ones who handle losses with discipline. The market doesn't reward perfect analysis, it rewards consistent risk control. Even with a 60% win rate, if your losses are bigger than your gains, the account won't survive. So Tom kept it simple: small losses, long profits. So he focused on asymmetry and not his win rate. And that's what you should do. A few things stand out here. Ego is the biggest enemy. Overtrading, doubling the lot size, and ignoring stops usually come from wanting to win, not from having a valid setup. Number 3, the market never reacts perfectly to perfect analysis, so mistakes need to be accepted quickly. And every loss teaches something. Each losing trade creates behavioral data that becomes an edge if you record it and review it. So let's make this practical. Never risk more than 1% on a single idea, no matter how certain it feels. Because certainty in the end is an illusion, but capital protection isn't. Use a proper journal as well, not just prices but your mindset, hesitation, fake confidence, doubts and discipline. And do not underestimate small repeated gains. 0.5% returns with controlled drawdowns outperform big 10% spikes over time. Longevity beats adrenaline. And this is how you turn this into a habit. You write one page of non-negotiable rules: max risks, minimum R&R, and an unconditional exit plan. Use short behavioral logs for every single trade, before, during, and after. 3 simple statements about your mental state and disciplines, and remember to review your week. Keep track of 3 repeating mistakes and 3 behaviors worth keeping. Put them where you can see them, and once a week, practice taking a clean, precise stop on purpose by training your mindset to accept controlled loss. And in the end, it all comes down to this: trading isn't about prediction, but rather about probabilities, risk, and emotional control. So the better you lose and the longer you stay in the game, the more you win. If you're tired of cycling through hesitation, excitement, and regret, start applying these simple rules. Professional training begins with discipline, journaling, review, and accepting small pain instead of a big disaster.